Well, good morning, everyone. My name is Roger Scott. I'm the head trader for Wealth Press. Today is Wednesday, June 24th. I know. Where has the month gone? Where has the year gone, right? We're halfway through. Summer's here. It's time to have a little fun in the sun. But first, let's talk about global economy. And then I'm going to talk about the opposite of what I said yesterday. Yesterday, I picked the strongest sectors, the strongest stocks. Today, I'm going to show you the weakest sectors and the weakest stocks right now. So let's get into it right now. So Asian shares were mostly higher on Wednesday with another mood boost from Wall Street, but fears are mounting over the surge of COVID-19 in different parts of the world. For example, analysts are warning that despite the recent market rallies, there's little reassurance infections won't keep spreading, given the number in some parts of US, Brazil, and Asia. I've heard that South America is really heating up. On Wall Street, the S&P has been kind of just choppy, kind of sticking to the 200-day moving average, as I predicted. Up, down, half a point, not really doing much at all. But it's on pace for its third straight monthly gain. NASDAQ, on the other hand, it's got a lot of tech stocks, and it's been climbing to all-time highs for the second day in a row. I love that. But, folks, you got to be careful. It's going to come down with the rest of the market, and I'll explain to you why in a bit. Bond yields rose, another sign of increased confidence in the economy. Healthcare stocks and companies that rely on consumer spending were amongst the big gainers. That's a very, very positive thing to see, while safe place sectors like real estate and utilities fell. I like the fact that healthcare stocks are heating up. But I got to say something. Healthcare stocks usually don't rely on consumer spending. That's the thing. Most big healthcare stocks rely on government grants and not consumer discretionary accounts. So this is very interesting. I'm going to have to look into this. Maybe this is like stores like Rite Aid and CVS. Those do rely on consumer spending. Investors have been focused on the prospects of an economic recovery as more businesses reopen after being shut down for God knows how long. Encouraging economic data, including retail sales, hiring, have helped stoke optimism that the recession will be relatively short-lived. I'd love to see that, but that's not what the numbers are showing. The World Health Organization said over the weekend, the pandemic is still in its ascendancy. That's not good. U.S., which is seeing rapid increase in growth, has the most infections and deaths by far in the world. 2.3 million cases, over 120 confirmed virus-related deaths. That's bad. On Tuesday, federal health officials told Congress to brace for a second wave of COVID-19 in the fall of the year. That's very, very bad for the market, folks. Investors have been placing more weight on economic data released that suggests economies that have been reopened are making strides to emerge from a deep recession. Further updates on the U.S. economy are expected towards the end of the week when the government will issue data on consumer spending, weekly unemployment aid, and durable goods. Actually, they missed the most important part. Tomorrow we have GDP, the biggest report of the quarter. They tell us that we're going to have big reports, but they just forget to say the GDP's coming. Not good. I'm watching you market reporters, you. So GDP's coming out tomorrow. The number you want to watch out for is 5%. If it's better than 5%, maybe better than 4.9, things are looking better. If it's worse than 5%, things are not looking better. That's the target, and that's what's priced into Wall Street right now. And again, I am thinking that we're going to have another leg down because, and I want to show you this. This is very disturbing. And I know. I keep saying the same thing and showing you the same thing, but I want to show this to you, folks. Please pay attention. I was showing this to you from the other side, okay, before this thing happened, and now I'm showing it to you like this. Look at this. And then we'll move on to what I really want to talk about today. Look at this. Only 30% of stocks in the S&P are trading above the 200-day moving average. Look at this. I want to show you this. That's consumer discretionary. Hold on. I went to the wrong place. Let me go to S&P indices. I went to S&P sectors. Excuse me. Mea culpa. All right. 76% and 41%. Look at this. I want you to see this recovery from a long-term perspective. I'm going to go max. That's like 15 years. We huffed and puffed the S&P on a monthly basis after being completely overbought, went down, market crashed right here, and now we're turning south right here. And it looks to me, unless this can rally higher, unless the number of stocks trading above the 200-day moving average can rally, we're going to come down again. And I have really strong confidence in that because when I look at the shorter term time frame, it's already happening. Let me show you this. Actually, I drew this about a week and a half ago, 2 weeks ago. This is a monthly contract, monthly time period, sorry. Look at how it's moving down. And it's going to keep moving down. And if the number of stocks trading above the 50-day moving average starts moving down, it will take the number of stocks trading above the 200-day moving average with it, okay? It's inevitable, and this will turn lower, and that's telling me that the SPY, that the S&P 500, the SPY, let me just show you here, is going to move lower, not higher. So everything is pointing right now. We have a descending triangle. We're hovering near the 200-day moving average, this ugly mustard-colored line, brown, mustard, I don't know what it is, tan. It's hovering around. We have a descending triangle, and momentum levels are telling us, clearly telling us, look at this. We never went even above the 50th percentile. Not happy. Not happy with momentum levels. Again, I focus on these momentum levels. This is where the S&P was before the crash. And I said, folks, we're not going to be staying around here very long. We cooled off. We went from 80% of stocks trading above 50-day line to 10% to 40, and now we're bouncing back down. So a lot of traders, I want to explain this to you, a lot of traders believe that the rally that we're seeing and that we saw the last 2 months is a new leg up. But according to my momentum charts, it's just a fluctuation and a bounce from the bottom, and we're about to revert back in the same direction. This is the 200-day. And when you look at the 50-day and you look at how overbought it is, and you have to realize it reacts faster. It's a shorter term index. It reacts faster. This tells me that we're coming down, not up. Now, in that light, I'm looking at sectors right now, and the sectors that I'm looking at, the real weak ones are utilities and financial. 6 month, 3 month, 1 month, these are the weakest ones, financial and utilities. So I'm looking to sell stocks in those two sectors. So let's look at my relative strength scan. I've highlighted 3 stocks for you: financial, and utilities. Let's look at each one, okay? All right, Cincinnati Financial, let's look at it on a, couldn't even go above the 50-day moving average, barely bounced. Let's go in a little better time frame. Look at the trend, nice weak downtrend. Looks like it's gonna, descending triangle again, looks like it's gonna revert back down. So, and I mean, look at the bounce this had. It barely had a bounce. Most stocks went all the way like up here, right? That's the 200-day line right here. This thing couldn't barely even go above the 50-day line on the way down. And the 50-day line is bearish. It's below the 200-day here. So this is very bearish. I would be selling the stock. The next stock was Wells Fargo. Let's look at Wells Fargo. Now, these are the same stocks that I've been bearish on for a month now. Yeah, this is terrible. Went up, rallied to the 50-day line, and bounced right back down. Also, descending triangle. Look at this. Look at this. Oops. Oh, that is a trend line. I'll never be a Picasso. I'll just rearrange that. Look at that. Descending triangle and a flat right here. Boom. Breakdown. And now let's look at the last one, which was Consolidated Edison. I have never looked at this stock. I mean, over the last few weeks, I have not looked at this stock. It's going to be the first time. But my CSI scan does not lie. Oh, yeah, definitely. Folks, you definitely want to look to short these stocks. If you're long these stocks, you want to avoid these stocks. The stocks are Cincinnati Financial, Wells Fargo, and Consolidated Energy. All right, ED ticker symbol, WFC ticker symbol, CINF. Now, look at what I did. I looked at my sectors. I looked at the weakest sectors. I looked at the overall stock market sentiment. First, I looked at the stock market sentiment. Then I realized that the momentum levels are moving lower. Then I looked at the worst sectors. I found utilities and financial. I looked at my CSI scan. I went strongest, and then I went weakest. The highlights are gone, but you could still see. I'll just highlight it here for you. Here, Cincinnati. Consolidated Edison, and Wells Fargo. And I'll bet you if we keep going lower, and again, I haven't even looked at this, but look at this. Let's see here. Simon Property Group. Don't like Simon Property Group. Let's take a look at Simon Property Group. By the way, I told you guys a year ago that Simon Property Group was going to be the weakest stock of 2020. Oh, it doesn't look good at all. Let's add Simon Property Group to that. It's a REIT, but Simon Property isn't looking pretty. Folks, the markets are wildly unpredictable right now. I'm sure you could see that just based on what I went through the analysis. NASDAQ is at new highs. Momentum levels on the S&P are coming down. Volatility is still above 30, which is very, very dangerous zone levels. In fact, I think it's safe to say that you can't trade the same way that you traded 12 months ago, 6 months ago, even 3 months ago. I'll definitely say that. So what are ordinary traders supposed to do? Well, the answer is really, really, really simple. Learn Tom Busby's brand new primetime stocks trick. All you've got to do is watch your calendar for a specific date, and you get that date 7 days in advance. Place a quick trade in your brokerage account, and then enjoy the potential for 350% plus gains. Tom Busby is the man. He's one of the best respected traders in the country. He's one of my mentors and one of the best gurus out there. Folks, this guy is a legendary trader. You'd be making a foolish decision not to join this. We launched this the other night, and we literally broke our website. It was so popular. You cannot afford to miss this. Check this out. It's going to be eye-opening. You'll catch me there. You'll catch Tom Busby there. We had an amazing time. Don't miss out on this. Really, do not miss out. Learn how to capture 350 plus percent gains in this type of market environment. Click the link below to get started today. Don't miss out on this. Don't miss out. Do not miss out. Don't procrastinate, don't delay, and don't miss out. I'll talk to you guys later.